Today we've got Michael Matusik for a property market update. We're going to be covering a lot of current events that's happening, including how fuel prices might influence interest rates, the war in Russia, what impact that's going to have on the property market, flooding, some of the natural disasters around Australia, and how that's going to directly impact property prices. If you're a first home buyer, if you're looking at getting a property, if you own property, you're going to want to watch this presentation. Michael, welcome.
Jayden, hopefully it's not a war in Russia, it's in Ukraine. But
all right,
you might know something more than we do, and hopefully it's
not be in the presentation.
Anyway, okay, so let's start. Let's start from the top. You and I know each other for quite a while, and you've attended some of the masterclass type things I've done. So I'm going to cover some of those tools that I think are very good ones. Quickly to set the scene, and then we're going to talk about the flood and Brisbane and a few other things. Okay, so let's have a housing market outlook. So this very simple tool, this is the property clock. Many of you listening know about that. If you don't, I have a website called Matusik, it's my surname, .com.au, and if you just search property clock, on that website, it'll have past posts which explain in some detail what stagnation, recovery, upswing and downturn and so forth mean and how the clock works. This is just a very simple tool to throw the darts at a dartboard or a clock and say, where is each market in Australia? This was done late last year. It hasn't moved that much since then. The major capital cities are in red. So you can see that Adelaide and Brisbane are in the beginning, if not halfway through an upswing phase. Canberra and Hobart are higher in the cycle. Darwin, Melbourne, Perth and Sydney are near their peaks, probably peaked now. So what that means, particularly in the Brisbane context, let's focus on our conversations around Brisbane for this presentation. It means that there is still some price growth, maybe not as much now that the floods have, happened, but there is still some price growth to happen, particularly in areas outside of which were affected by rising water, and there is some increase in sales and so forth. So the market is still improving, but it's nearing its peak. And then what will happen, it will slow down. I think my reading on the market moving forward is that things will slow down and at best stay steady for 5 to 7 years after we reach peaks, which is not a bad thing if you've already purchased. And it's not necessarily a good thing if you're desperate to get in the housing market and you can't afford to do so. I don't think there's going to be a major downturn, but that depends on what happens overseas, and we'll get to that at the end. So I just mentioned a longer term outlook, about 5 to 7 years. If we actually look at a shorter term outlook, what drives prices in Australia is, on the macro scale, is housing finance, and that's influenced by confidence and interest rates and those type of things. And you can see this chart basically just shows past house price growth on an annual basis across Australia in the blue line, possible house price growth in the next 6-month period. So it is heading downwards, but it is still above the dotted line. So it's still positive, but it's not growing as fast. And the black solid line is brought forward 6 months because it's a lead indicator, and it's housing finance. So that's people who have gone to the bank or via a broker like yourselves, secured their finance, and that's money that's really allocated to buy a house. Some of it doesn't happen, but a lot of it does because it's been approved. And that often takes 3 to 6 months for once somebody's gone and got their ducks in line in terms of what they can borrow and the terms and so on and so forth to actually find a home. In other words, to buy a property, have it settled, and then it reflects prices. So that's why we bring that forward. And you can see there's a very close relationship between the two. What drives sales volumes is confidence. And confidence is just a measure of when it's over 100, as you can see on this chart, it means more people are optimistic than pessimistic. And when it's below 100, it means more people are that should be less people are optimistic than pessimistic. At the moment, confidence is a little low because of what's happening with the floods and also what's happening in the Ukraine. So that will see sales volumes start to slacken. And that's one reason why the market is likely to peak sometime soon in the next 6 to 12 months. One, because there's less action in terms of sales, as shown in the blue line. And also there is less people taking up home loans. It can't always go up. So we've had a good couple of years and it's slowing down.
There's actually a good chart that Michael has on his website where it correlates consumer confidence to election results on his website, matusik.com.au. So check that out. We're not going to cover it today because it's out of scope, but it's a good leading indicator for what might happen in the federal election later in the year.
Yeah, that's right. And that's a pain index particularly, which I call a pain index, which is a combination of inflation and wage growth. When inflation and wage growth are not going in the right direction, that indicates pain to most of us. All we're interested in is how much we're paying, how much money we're earning really, and how much it costs to finance things. And when they don't head in the direction, we've seen changes in governments, and it's looking like it's going to be a pretty close election. And that will, and I do think as a result of that, there might be some things thrown at us, not just reductions in fuel excise. I don't know about you guys, but
that was interesting in New Zealand.
Days and everything's over $2.30. Even diesel's at nearly $2.50 just down the road here. So, we'll get to that soon. And you can see that when one of the other side of things in terms of demand we talked about was sales volumes. One of the things why I think that we're not going to see a collapse in the house price, but we're going to see a stagnation when things settle down in coming 6 months or so, is that the fact that the supply of stock shown here in the bar chart is very tight. So in Australia, there's only 4 or 5 months supply of housing on the market. Where prices have fallen and really fallen below the zero where the line is, that's when housing supply has been in excess of 12 months. So it's going to take a lot of supply to come onto the market. I know that sales volumes are likely to fall, but still it's going to take a lot of supply on the market to actually make that happen. So real estate essentially is supply and demand. And we've seen supply being very, very tight because of COVID restrictions. A lot of people may have sold their house, but haven't in recent years. And as a result of it now being the restrictions being removed, fingers crossed that continues, then you're going to see supply naturally increase. But to get it from 4 months to 12 months is a lot of supply. I think most people will hang on to that property, particularly if they've had their recent purchases and they've had good gains in that property. It's windfall gains and they'll keep them. And the demand has been lifted because of low interest rates, and also because of JobKeeper and the like increased the average wages across Australia, particularly in real terms when you take in case of inflation back then. So the beauty of the current market and its forward projection is that there isn't a lot of supply coming onto the market. It will increase and demand will fall, but I don't think it will become out of balance as it has done in previous cycles where downturns were somewhat hard. Now, that could happen. That could change if we see very rapid rises in interest rates fueled from overseas, but I don't think that will happen. I don't think it will take much in terms of interest rate rises to control not so much inflation over the short term, but over the longer term. I think that won't take much to do that. Only a couple of % at the maximum, but we'll get to that. And this just shows the vacancy rate. The vacancy rate's tight across Australia, and as a result, rents are rising. There's some reasons why that vacancy rate has dropped quite sharply from, say, 2% to 1.7%, although across Australia it was heading down that way anyway. If you went to 2015 to, say, 2018, that dropped because of a lack of investment lending in Australia. That was because APRA tightened the screws around investment lending, and that saw less people buy an investment property. And then the recent falls have been, one, because of changes to rental regulations because of COVID, so people couldn't be evicted who were renting, or they were frozen on rental markets. And so some landlords said, hey, I'm not going to rent my property out, I'm just going to leave it vacant. Also, some landlords use that property to house their relatives, particularly their kids, so they weren't advertised, because the vacancy rate is an advertised thing, property for rent. Also, another factor in that is that the supply has tightened up as well. But rents usually increase when the vacancy rate is tight. So that's not a bad thing, particularly if you're an investor. And I think one of the things moving forward is, whilst there will be not much price growth compared to what we've seen before, you're going to see rents continue to increase. And the key thing for me, and has been for some time, as Jayden will remember from previous masterclasses and conversations we've had over the years, is the key to having a real good investment property is to be able to house more than one tenant. So if you're buying something, if it's an apartment, make sure that it's 2-bedroom, 2-bath, and they're the same type of bathrooms and en suites, because you can get 2 tenants in there. If you're buying a house, make sure that 2 or 3 tenants can live in that and live independently. That often means a dual living or dual occupancy type home. They can be not only new homes, but they can be purchased in older homes. So in many locations in Brisbane, despite some of them getting wet recent month, many of those older homes are perfect to make into dual occupancy homes. There's an upstairs, downstairs living, or they can be divided internally, or even subdivided out the back with some, planning approval. So that type of thing, I think, is a key thing for rents and yields. But also it's an increasing thing wanted by the person who's buying it off you in some future, because despite what we hear, there's a rising household occupancy in Australia, not a declining one. In other words, there's more people per house living in a house. That's just what happens when you don't build enough properties. Rental vacancy rate's an indication of that. And also that many people can't afford to rent and or purchase a big property, and some of them need help to pay for things, and they get a tenant in. So, or they live, with their family for a lot longer. Many listeners will have somebody in their 20s who live at home or have boomerang back several times, or they're listening and they're one of those boomerang kids and they want to maybe do something about it. But, you probably won't move far from mum and dad, so you can at least bring back your laundry. So
a couple of suburbs along. And even on the vacancy rate, another thing that you'd mentioned a bit earlier, and probably to keep a lookout for Michael's blog, is just how vacancy rate is reported. And so you said there's going to be an upcoming feature on your blog, so check that out, where some of the punters out there don't report vacancy rate as at today. There's like a delay. And so the stats you might be reading, you might be wondering why one website says one thing about a vacancy rate in a suburb, another says another. So again, check out Michael's website for that. It's not out yet, it's something he's working on, but I think it'd be interesting if you're looking at investment. Obviously, if you're a first home buyer, it's probably not as consequential.
Yeah, and on existing on the website, and you can look at all my past posts. I post something every Tuesday at 8 p.m. In real time, 9 p.m. in Queensland time, daylight saving here, where I am. But I post something that evening. It's pretty high open rate, so a lot of people do read it, which is nice. And a couple of weeks ago, and you can read all the past posts on the website, and I wrote something called My 7 Rules for Statistical Analysis. Or it had a funkier title than that, but that's what it basically was. And it actually outlines what you should really look for when you're reading stats. And Jayden picked up on that, being that, got to really go a little bit deeper when you say somebody says a vacancy rate. So, okay, what does that mean? What are they really measuring? Is that really the properties I can rent today, or is that some other measure? And often it's some other measure, which you wouldn't think it is, but it is. This shows you a very long cycle of what house prices have done in Australia since records were kept in 1881. So it's when the first banks started to operate outside of, having it going back to England and all those type of things. So records were kept. Some of the data at the early days were just for Sydney and Melbourne, but somewhere in the Federation around, 1901 or so, it was nationalised. And this shows in real terms last year's dollars. So just say that if you went back today and with your money and could purchase a house in Australia in 1881 in today's dollars, would cost you about $60,000. Whereas last time I did this, this was in March. I've got to update this chart The trends ring true. There was about $750,000 for the median price in Australia. It's about $850 now. The key part of showing this chart is when prices have gone through a escalating period in terms of growth. As you can see, they did from early 2000 to 2010. They had a period of 4 years where they didn't do too much. And then if you go back previous cycles, you can see that there's always a resting period. So I just look at it simply as this. You've had a really big meal the last couple of years. We've gone out, we've had a great meal, we've eaten too much, drank too much. We're going to now have to have a little bit of a rest and a lie down and a kip, and maybe not eat much for a couple of years. Okay, so I think the next outlook, because the growth was so strong and interest rates dropped so much, and the pandemic added more fuel to that in terms of the handouts from the government, which I think initially were needed, maybe not continuing through the process, but they were given. You've seen a period of a strong growth, and there's going to be a rest period, I think at least 5, maybe even longer years. And this is just what happens. Some people have asked me about this chart and why was the big lift between 1950 and 51 in the middle of the chart. That was simply because during the Second World War and after the Second World War, there was you couldn't increase prices in Australia. There was restrictions on what you could actually ask for, and that government set the prices. Remember, it was World War and so on. And then in 1950, that was released. So you saw a substantial jump in what people could actually achieve for their prices. That's a once-off. I don't think that's going to happen anytime soon. Fingers crossed anyway. So this basically has a chart that shows that it's a long-term chart, and it shows that there is rest periods. And again, I've written about this somewhat at length in previous posts, but I think that's going to happen next time. So overall, many markets are near their peak. They're going to take a rest. There should be a flat period and hopefully not too much of a downturn. Now let's talk about some interest rate, wages and population growth, because they're some of the major drivers that affect supply and demand. Okay, so let's talk about interest rates. This chart basically shows that interest rates are likely to rise. This was done late last year. It's moved up a little bit since then. And basically it shows the yield curve. So it's the cost of short money versus long money. We won't maybe get into it more than that, except to say there's a lot of precedent to show that when it's over 0.5%, that's the government bonds minus the short-term market being 90-day bank bills, that the cost of money is going up and that interest rates usually rise. They would have been rising already they wouldn't have dropped as much as they did, but they would have been rising already if it wasn't for the pandemic. So, at the moment, the cash rate's nothing. I think that'll start to rise. It'll rise after the election. I've said that even early last year, I got caned a little bit because I said, look, it's political and it won't happen till after the election. Morrison will probably go late, as late as he can. That means it'll be May, so you won't see anything till June, July, August, playing it safe. Back then I said August. I think you'll see something in June. It'll just go up by to 0.25%, so 0.015% increase. That will be passed on immediately to the mortgage, to the variable rate. Long-term rates are set differently, and so they're already rising, as many as you know, and as many borrowers know. And then I think after that, they'll rise by about 0.25% every quarter for at least a year to 2 years. So I think interest rates are going to go up by about 2 to 2.5%. And many people are already either not paying that, or their buffer of their loan is in excess of that. So, and 60% of home loan people who've borrowed money in the last 2 years are 60% are a year plus in their payments. So for some people, it won't be an impact. On the market looking to buy, many of them won't be able to afford the increase. And the increase is probably, at worst, it's probably $700 to $1,000 more per year over a typical house, which for many won't be like a big deal, but for some it'll be an impact. But it'll be enough to slow the market. Well, hopefully we're right. We haven't got a crystal ball, particularly. Who would say?
We've been saying, like, based on commentary, like even the banks have said interest rate, like neutral interest rates need to be at 3.5% to 4%, and they're currently at 2.5% to 3%. So I think 1.5%, like, it's already priced in there based on some of the fixed rates that are out. So if you're worried about it, fixing your interest rate. If you want to take a punt, stay at variable and see what happens.
Yeah, and inflation's going to rise, and it's going to rise quite sharply, and we're going to all feel it in terms of things like petrol, and we're going to feel it in terms of the price of food, particularly stuff that is exported or influenced by Ukraine and Russia, such as wheat, but also a lot of potash and fertilizers and so forth come from the Ukraine and Russia because of the embargoes that are placed and restrictions placed on Russia. So we're going to see that come across the board. So things are going to get more expensive. Doesn't necessarily mean, unfortunately, that people are going to get more increased wages. We'll talk about it in a minute. And short term, the next 6 months to a year, inflation is going to be quite high, 4 or 5%, maybe even higher. But looking through that, and the Reserve Bank hopefully will do that, and there's recently been a resignation of the deputy, and so that'll be an interesting time for the Reserve Bank because the next appointment won't come internally, it'll come from somebody outside, and normally there is a review if something like that happens. And I think there's a review coming up. I don't think they're going to necessarily change their way of thinking in terms of what they're there for. They're there for to maintain inflation. But hopefully they will look through that and say, we don't have to increase, we don't have to go, up by 1% increases or 0.5% increases each quarter. We're going to have to apply the brake, and we're going to have to start doing it. We're going to raise it up to, as you said, a neutral rate, which is about 4% odd. And then we're going to, if we get caught and the economy tanks and there's, the world's facing a recession, which could do, then we can print money, or we can generate a demand beyond just trying to drop interest rates, because you can't drop them anymore. All you can do is print, basically circulate more money in the economy. So there's
during COVID, and I guess there's a precedent set there as well.
You keep reading about, and some of you are still hoping, no doubt, and if you're lucky enough to get the wage rise, good luck to you. But for many people, there is no wage growth coming. There's generally a trend that still exists between, if unemployment's tight, wages go up. But you could see this chart basically shows that in recent years, the line of where if unemployment was heading towards, say, 3 or 4%, then wages grew by 3.5% to 4.5% and per annum, and everything was really good. You were staying above inflation, you were making some money. That reflects tight market. That trend's been broken. The reason that's been broken is simply because of automation, internet, robotics, and that's taken up particularly more so than many of us think. And jobs are changing, and a lot of things can be packaged and so forth. I read recently that the sorting of recyclable material is about a 1% success rate for the human eye to do it on a conveyor belt. It is 100% for a machine, and that alone will affect hundreds of jobs in Australia. They won't be employed. They'll be doing other things. They won't be necessarily sorting out renewables and reusables. And so, when you take your stuff to, and what drove that was the fact that we didn't do any about that for so long because China wanted our recyclable stuff. They said no. So we have to do something with it. We just can't, there's only so many landfills we've got. And there's a green vote and all that stuff. So those type of things happen, and they affect the market, and they are influencing wages. So there isn't automatically a tight unemployment rate means that you're going to all get wage growth. Sadly, that's not the case. So that slacks demand. Also, what's happened as an indicator of wages, first this chart 8, this is from a post that's coming up in a couple of weeks. So you are seeing a few things that I haven't aired publicly because I write these in a bit in advance. You could see the first chart shows wages, and it really went up during the pandemic in 2 lumps. That's because for many, JobKeeper was high. It gave them more money than they would have normally earned in real terms, particularly when inflation went down because of COVID, and also that payment increased wages. So it went from about 70,000 to 74,000 per annum. It dropped quickly because that only lasted for so long. And then what happened in New South Wales and Victoria, those 2 major economies actually got some form of assistance as well, and that lifted it up to 71. It has now fallen to the lowest level since 2012 in terms of real compensation per job. So even if you're getting some wage growth, it's nothing in real terms. And the next part of that slide is a simple table that shows the change in the last 12 months in real compensation work per hour by the total workforce. So 57% of people out there, some of these listeners, I know for one that my real compensation per hour has dropped as well. 57% of us actually saw our real wages fall or income fall, and 14%, 1 in 7, saw that fall by 10%. So think nurses, doctors, health workers. Some people saw, such as loan brokers, they saw their gains go up more 5%. But even then, wage growth that has happened, 43% of people saw their wages go up in real terms above inflation. But most of those gains were small. So you hear a lot about wage growth and it's coming and so forth. The reality is that it isn't. And for many people, when you factor in inflation, it's declining. So I've said inflation is likely to go up. I think it will in the short term. We're going to see more pressure, therefore, on many people because of their wages won't go up in real terms. They won't be able to buy as much bread and definitely not buy petrol as they used to, and so forth. And those things will slacken demand. And that's another reason why the market's likely to peak and you're going to see it flatten out at best. And that's good if you're looking to buy a property because you've got a little bit more time. There'll be more choice. You don't have to maybe rush as much. You can search around and maybe buy something better bang for your buck, so to speak, rather than saying, geez, I better buy this because, it's going to sell and we're just going to miss out and so on. I think that a more sane period is just around the corner.
Mm. And even I think you'd done a piece on it maybe a year ago where, what was Ilion? There was a piece where it had concentration of say hospitality workers relative to suburbs, looking at how they were potentially going to get affected during the pandemic. And then obviously JobKeeper kind of allayed those issues. But I guess it could be something based on some of this data that could be interesting moving forward that I'm sure you probably help people unpack in the masterclass and that sort of stuff too, and where to look for it.
Yeah, we're touching on a few things and a little bit, like picking the eyes out of the, picking the, not the pearls, but, picking some things to discuss today. And when I did this work, I was surprised. I didn't expect to see anything like this. So much so that I was just going to write about a few, just basically saying the wage growth is limited and it's limping and, that affects demand and it affects demand in this ways and so on. And then I said, well, look, I'm just curious how many people really had a wage growth in the last year in real terms, because it's fine to say, okay, I got $100 an hour, and it's fine if that if a year ago that you had $70 of that left, but if you get 110 now, that looks great. But if you've only got 65 spending power, well, it's not good at all. Might be good for the ATO, but it's not good for you. So I look at it in real terms. And so what we've seen is I was surprised at the numbers. When I first did it, I thought, geez, I made a mistake. I've got these aren't right. But I triple checked, and that's what it is. So many people are feeling it, and that means less demand, and that should mean with an increase in supply, more choice for you if you're looking to purchase. Just quickly, there's been a lot of, this is a topical thing, and you're going to see more migrants to Australia. One, because Australia is going to open its borders and see something like 230 to 250,000 people per annum. I think you're going to see a lot more people come from Europe, particularly the Ukraine, and including also Hong Kong, and possibly from Taiwan. And we're going to really Australia will be accepting those people with open arms, because many of them are very qualified, particularly out of the Ukraine and Hong Kong. I don't know about Taiwan. I assume so as well. In terms of, they've got things that we want. They're good at trades, they're good at doctors, they're good nurses, they're good engineering and scientific type mindsets and education. I'm not having a go at other migrants. I'm just saying that that's a skill set that I've read a lot about in recent weeks, particularly out of Ukraine. I'm from Polish extraction, so I know a little bit about it as well. So those things are going to influence the number of people coming to Australia. One of the things that has happened in Australia, and I think is a very misinformed conversation in recent years, is how many people have moved to regional Australia, so outside of the capital cities to a region. A couple of points. Firstly, the Gold Coast, Sunshine Coast, Newcastle, Wollongong and Geelongs are all considered regions. Now, my simple take on things is, if you've got a traffic jam every morning on your border, and every afternoon you've got the same traffic jam, say you're the Sunshine Coast and people are coming from Sunshine Coast to Brisbane for work and back for, you're not really a region, you're part of the capital city fabric. So some of this growth is misread by saying it's it's really a capital city. So park that aside. The other thing is that migration is a combination of people leaving and arriving. Okay, and this just shows you the press has made this out like it's a chart that so flies off the page, where you can see it's only a 45,000 increase versus something like 25,000 a year before. Note that it was starting to decline in net terms. That means departures minus arrivals minus departures, up until the pandemic. Into the pandemic, and then changed, okay? So one of the key things that's not talked about, and I read headlines about this, and I see people saying, oh, we're going to buy in a region, it's booming, so many people are moving there, it has to be a good thing as an investment. I'm not saying you shouldn't buy in a region, I'm just saying their argument is a poor one. So this just shows you, excludes the capital cities. It just shows you the arrivals to a region, which sadly includes the Gold Coast and Sunshine Coast, but the official figures do that, so we've got to keep them in there. It shows in the grey bar chart the regional arrivals, which you can see prior to COVID was moving upwards quite rapidly. And then you can see since the pandemic, so particularly over 2020 and 2021, you can see the number of people leaving a regional town has declined. And that makes sense, because young people largely leave a region and they haven't been able to because they can't go overseas, or they really can't go to Sydney, Melbourne, Brisbane when those cities were in lockdown. So what you're seeing is the net result increase, as we showed in the previous chart. That's because of the arrivals minus departures. I believe what will happen, and is already happening, is that people who have actually either moved to a region because they, could work from home and it was a break from the capital city and whatever, or haven't left the region because they couldn't get out, will start to do so, and in earnest in the next couple of years. And if they are commuting between the two and they're spending 2 to 3 hours plus in the car, with $2 plus per petrol per litre, I wonder how long they'll put up with that commute. So one of the things that has influenced those regional rental markets is a short-term reallocation to movement to those regions, which I think will then see them go back to particularly capital cities and in inner city locations where the rental vacancy rate was higher, and see that all balance out. So beware of a regional town, and when you hear about, it's booming and the population's this, that and the other, you've got to ask yourself, well, how many people didn't leave that regional town And you can find that out from ABS or come to a masterclass or read this type of stuff I write. And you'll find more often than not, just people didn't leave for a period of time.
I'll include a link below as well. Michael did a really good write-up. You read a lot of headlines about people moving to Queensland in droves and how all the other states were shedding numbers. He did pretty good unpacking it on the blog. I'll include a link below. It's not to be covered now because we don't really have time for it, but check it out.
Yeah, okay, and people often move for really obvious reasons. A lot of people think that, it's because of the economy or everything, because they liked the place. They couldn't make it in Sydney or Melbourne, or they had a holiday and it was a really good time, and so they said, let's move, and let's move to
Sydney to Brisbane.
Yeah, let's move to the northern suburbs. Why did we pick the northern suburbs? Because we went to the Sunshine Coast and had a really good time, and so we thought, we'd move close so we could go back to the Sunshine Coast. Nothing wrong with that. I live in Tasmania because it was a long-term decision, and we moved into place of Tasmania because we really liked it on one visit. So here we are. I still travel a lot for work, but here we are.
So on the flood impact, there's been a lot in the media saying how, in some pundits are saying it's going to be blip in the ocean as it is. Things are going to recover. It might have an impact on rentals. So Michael's did a pretty good feature on this again on his blog, Matusik, but let's run through it.
Okay, quickly. One thing as well is that Brisbane floods quite regularly, okay, and so does Ipswich corridor. In fact, for all flooding, there's a 20% chance that Brisbane and Ipswich will flood each year. Now, it won't flood to a major flood. It'll be a minor flood, so not many people know about it, but there's a 1 in 7% chance that Brisbane will flood a major flood every year, and it's a 7% chance every year that Brisbane will flood and have a major flood, and it's a 13% chance that Ipswich will do so. It's not going to happen every year, but it does flood. So if you don't want to be in an area that floods, find out what that area is. Secondly, if you're happy to live in an area that is compromised by floodwater, make sure you actually buy an elevated house or do whatever you can in advance so you protect the area from being inundated. Okay, so quickly, I've looked at the past major flood, which was 10 years ago, and tried to look at what happened then and what may happen now. So first of all, we've seen that in the 2011 flood, sales volumes actually tanked for a period of time, then they picked up. Prices actually took a rest for a period of time, but in due course picked up. The real key to the analysis I recently did was that it took overall the market, this is for Brisbane, Ipswich and Logan, the 3 local government areas that were affected. There's over 2 million people living in those areas, so it's a pretty wide area. It took 33 months for the price that was achieved just before the flood to actually recover. Those flooded suburbs took nearly 4.5 years or 54 months to get back to the price. And the suburbs not affected were also impacted, and that took 21 months. Now, the impact on the dry suburbs were minor. At the worst case, it went down 5%. Overall, it went down 10%, and the flooded suburbs went down by about 25% in value, but then did recover. And from mid-2015 or so, they recovered quite strongly because many of them were on the water and near the river and in better located positions and so forth. So I don't think that's necessarily going to happen this time round because the supply was strong. It was a lot higher. And also the market was in a downturn phase in 2011, and that downturn was quite a strong one relevant to where we're heading now, okay? But there is going to be some impact, and it's going to have an impact in the flooded suburbs. If you could look past the floods now, I know many people who made some very good money as investments by buying in those areas inundated in 2011, held it for a period of time. They did a lot of the work themselves, or family members did the renovations and fixed that up, and they sat on some pretty strong price growth and rental growth as well. But you've got to look through the current period of and have a longer view.
And even presents opportunities for first home buyers to get in suburbs that they might have been priced out of previously.
Yeah.
Obviously, you just factor in insurance costs, but
yeah. You can see that listed for sale was in the first blue chart up there was actually high and rising. You can see the properties listed for sale in the Brisbane region is actually quite tight in comparison. They're the same scales. So again, that same story of, well, there's not a lot for sale. You can see dwelling approvals actually affected somewhat dramatically after the previous flood, and we're going to see that happen again. So you're going to see less dwelling approvals in a period of time. I could argue that Brisbane has probably created enough homes in recent times, but if it slackens off a lot, you'll see a lot of building growth like you saw in 2013 to 16. So we're going to see less building. One of the things that happened in the last flood was that building costs for not only detached but attached dwellings increased. They rose by about 3 to 5%. But this time around, we know that construction costs have increased a lot. They've increased by 20% in Brisbane over the last 12 months alone, and about 7 to 8% for attached dwellings. That's going to continue. So to build a home is going to get expensive. That's why you're going to see a lot less construction take place. When we open up our borders to more overseas migrants, we might be able to get more tradies here. And I know the Queensland government's promoting to come to Queensland and work here and so forth. Interesting, given they didn't want anybody here in COVID, but that's a sly remark. So that might ease that off, but we're going to see that pressure on there. And interesting, general inflation didn't rise much after the 2011 flood, but I think that's different now. That chart also shows how much it's gone up in the last 12 months, and it's going to stay elevated. Job creation was actually a positive after the last flood as people, mucked in and fixed things and rebuilt. You can see that Brisbane has really boomed in recent years. It went through a negative period, so some of that's catch up, but that reflects the coal industry, the building industry, and the infrastructure build, some of it fueled by the Olympic Games, but other than just in terms of commitments to building infrastructure. Hopefully that won't be too much affected by the floods and the current issues facing some builders, although that's probably not washed through. What we also saw, which I do think will happen this time round, subject to how many people come from overseas, is that we see population growth slacken for a period of time, and that makes some sense. Do I going to move to Brisbane? Does it flood? I've got problems if I move. A lot of people who move, particularly from interstate to Brisbane, come from the Sydney region, and they've also been flooded. So I think you're going to see that slow down on a historical average, but then pick up again. So in the wash up there is that we're likely to see the Brisbane region enter the peak of its cycle a little quicker than it may have happened before the flood. It's going to lose some of its price growth. I still think overall in a dry suburb, there's probably 5+% price growth this year. In those wet areas that are affected, the price growth's finished, and we will probably see falls in some properties of about 10+%, and they present buying opportunities, in my opinion. Again, I'm not saying you buy one and you make money. There's a lot of caveats on what I've said. This is my opinion, not advice, but I do think there's some opportunities there.
And then to the masterclass, so it's really interactive, really small sessions. Strongly suggest you check it out. Michael's hosting one coming up on the 25th of March at the Regatta Hotel in Brisbane. So 8 a.m. to 12 p.m. I'll include links below. Anything to add? Yeah,
thank you. And that was me when I had not as much grey. And a bit trendier. So masterclass has been rescheduled because of the obvious reasons. It was supposed to be earlier this month. There's a couple of spots left. And it's 25 people. It's half a day. Then we have lunch downstairs if you want to join us. It's pretty interactive. You meet like-minded people. You've had some people come in the past. Again, it was booked out, but a few people couldn't make the change of date. So there's a few seats left available. Go to the link. And if you just quickly go to the next slide, Jayden. This is what my website looks like. So you can see it's matusik.com.au. There's a range of buttons on the side as websites are, but that was the flood impact post, and you can scroll up and down that to read all of them, or you can just say, I want to know about rent. So you just type in rents, and then the 7 posts or 12 posts or whatever about the rental market will come up, and you click it on. There's only one picture on the whole website, which sadly is of me, and the rest of it's content. So, and it's free to subscribe, although I do like a donation. So on occasions, if you read something, you go, wow, that really helped me, or I found that entertaining, then you can give me a donation. There is a donate button. So Subscribe first, donate second.
No, so definitely check it out, matusik.com.au, if you're in the market looking for your first home to an investment property. I think it's really great, especially some of the regional opinion, that it's kind of counter to what some of the bias agents are saying, where they're all about the regions and how it's booming, whereas the actual data might indicate otherwise. Michael, thanks heaps for your time. Appreciate it for today. And if you want to check out any of Michael's content, go to matusik.com.au.
Thanks, Jeff. I'll speak to you soon. Bye-bye.